So we're now going to start formal course material. Start of every topic, I'm always going to have a slide that summarizes what we're going to do in the topic. It's, you can kind of think of it as check marks that we're going to be going through as we go through the notes. So this first topic, I call it Introduction and the Life Cycle of Startups. Today's lecture, what we're going to talk about are, a definition of startups, and given our definition of our specific definition of startups, what are some of the key and unique characteristics of startups and implications of that uniqueness. So given what's unique about startups, what becomes unique about their life cycle? What is unique about their funding life? You'll notice in this class, I use the word life cycle a lot because really startups are evolving creatures, right? So it's not like you're an adult and you will stay an adult, right? It is, you are a child who will become a teen, who will become a McGill, awesome BCom student, who will then become an amazing adult, right? Life cycle, it kind of matters here. We'll talk a little bit, again, high level, about the unique analytical challenges associated with startups. Talk also briefly about the unique way that I think about classification of startups. There's an implication that I haven't included here, but I also have in the notes. I'll probably not have the time to talk about it in class today, which is a unique distribution of returns for startups as well. But I will be re-emphasizing that point many times during the semester. So even if it's in my slides, not discussed, I will be mentioning it later anyway. So it's not going to be something that you guys are totally oblivious to. So that's what we're going to do today. The rest of topic one after that is going to be really going into much more nitty gritty and covering a lot of real world examples of each of those stages of the life cycle of startups so that we can really understand, as I said earlier, the challenges that startups systematically tend to confront over their life cycle, and some of the creative and interesting ways that various startups have successfully navigated that. I think very much in a startup context, it's helpful to keep track of startup stories, both successes and failures, because those things can be really informative for thinking about what sort of advice you would give to new startups that seem to be navigating similar oceans, so to speak. So if you guys don't mind, modules 2 to 5, I won't go and summarize more than that for now, but we will discuss them at length each time. All right. But let's go ahead and start the first part. So I want to start with a definition of startups because, as I said earlier, the course may say entrepreneurial finance, but really I think of this about startup financing because I make a distinction between two types of entrepreneurial ventures, right? Small scale entrepreneurship, you're opening a restaurant or something like that, right? Versus the really high scalability, high ambition type of entrepreneurial venture that we come to associate with oftentimes technology, but not necessarily always technology oriented startups, where the goal is to build something that is going to become very large. Those are two very different things. And the way you analyze them is completely different. The way they get funded is completely different. VC is only interested in one. It's interested in the startups. It's not interested in small scale entrepreneurship. Right? So I'm only focusing on one because that's all we can do in this course anyway, right? But I want to be absolutely clear about that. And so then the question becomes, well, how should we think of defining a startup? Because that's going to inform a lot how we analyze these startups, what sort of advice we give to them, and a lot of the things that we end up discussing in the course, how we evaluate them, how we value them, so on and so forth. So I'm going to give you guys a definition. But actually, I'm going to build my definition off of descriptions of startups that people with much more real-world experience than me have provided in public domain. So I actually have quotes here, which involve morsels of the definition of startups coming from 5 different prominent practitioners in the startup ecosystem, a mix of founders and investors. All right. And each of these definitions that get highlighted here are picking up a key and unique ingredient of a startup. So I like them collectively. The sum of the parts is greater, whatever, 1 plus 1 plus 1 plus 1 plus 1 plus 1 is greater than 5. So the first quote is coming from Paul Graham, successful startup founder during the initial wave of .com successes in the late 90s, early 2000s, but most well known as being the founder of Y Combinator, which is the most successful accelerator program in the world. So Y Combinator was the first investor in Airbnb, in Dropbox, in Stripe. So extremely notable in its impact on the startup ecosystem. And Paul Graham is the key founder of that organization, although he doesn't run it anymore. It's one of the things, once you succeed enough times, you don't need to do it anymore. So who knows what the future of Y Combinator is going to be like. But this is something that Paul Graham says. He says, look, and this is going to kind of sound maybe a little bit trivial when I say it, right? But I still wanted to include it because it's an important fundamental starting point. But Paul says, a startup is a company designed to grow fast. Being newly founded does not in itself make a company a startup, nor is it necessary for a startup to work in technology or take venture funding or have some sort of exit. The only essential thing is growth. So to me, this is really the starting point of a definition of startup. It's really about ambition. Okay, a startup is something that starts at nothing, but wants to go damn far, right? It doesn't want to build a $10 million business. It wants to build a $1 billion business. A lot of people would be very happy doing something that's $10 million. A startup, that is not their goal. That would be viewed as a meh-ish outcome, okay? So the goal is really to achieve huge value. So to have a meaningful component of an important and growing market. General rules of thumb around that is you want to think of a company that can be worth $1 billion, or you want to think about a company that could achieve annual revenues of 100 million, or is entering in a market where it can capture meaningful market share, where the market is like $1 billion a year, right? These are the kinds of hurdles that people are thinking about when they're thinking about what's the right level of ambition. So that's a starting point. That's like criterion 1 of a startup. It's that really supercharged ambition, okay? What are some other elements of the definition? So another definition comes from Eric Ries. Eric Ries is a serial startup founder, successful, has had multiple $100 million plus exits, not from recent times, but from, let's call it a decade ago or more, when 100 million actually was something. I guess it still is, but now people shoot for $1 billion, right? But Eric is also probably best known as being the author of the book, The Lean Startup. And that's really a book that, alongside another book written by the next person I'm quoting, Steve Blank, has really had a deep impact on the way people in startup ecosystems think about early life startup strategy for startups. Hi, Deborah. So that's a great book, by the way. I'm not going to assign it in this course, but it's a really quick and easy book to read. So I highly recommend people read it. It's literally the kind of book where, you can read it, 10 minutes a day before you go to bed, and you'll be done reading it in 2 weeks if you're a moderately fast reader. It's short and easy, and it's worth it. But he has a great quote in this book where he says, look, a startup, okay, he uses the word human institution. I don't know why that's necessary, but what I care about is it's an institution that's designed to deliver a new product or service under conditions of extreme uncertainty. So this is super important, the extreme uncertainty element of startups. When they start, if things go well, they can reach $100 million in annual revenue, but there's a great chance that things aren't going to end up well and that they'll potentially and often go to zero, right? So there's a lot of uncertainty here. And because of that, there's not a lot of historical data, right? It makes it difficult to do a lot of things, right? But that's basically that's something that you see almost entirely for early stage startups, right? You're taking a bet on something that you think can happen, but there's a lot of questions on whether that will actually happen or not, right? Steve Blank who's actually probably the main mentor of Eric Ries, serial founder, also someone who lectures on entrepreneurship at Stanford Graduate School of Business and the Huss School of Business at Berkeley. And he has written an absolutely wonderful book called 4 Steps to the Epiphany, I think. I might be remembering the title a little bit wrong. That's like a supercharged version of Lean Startup, but it's also one that will take you much longer to read, like 800 pages long. But he has a great quote. He says, look, a startup is a temporary organization set up to search for a repeatable and scalable business model. So what does temporary mean? It's about evolution. What you're trying to do early on is figure out how to get to this large ambition, right? So you need to find something that people want that you can deliver to a shitload of people, right? Because it needs to be scalable for it to be able to reach that ambition. You could have a big market, but if you're not able to scale production, you're not going to capture a meaningful share of that market, and you're not going to generate enough value to achieve ambition. So you need scalability, right? Your goal is to figure things out early on as a startup. That's why you're in temporary mode, right? And in order for you to reach your ambition, it needs to be scalable, repeatable, predictable, some combination of all those things, right? So that's a really important goal. The extreme uncertainty means that Ries emphasizes means that you need to be learning early on with a startup. It's less about experimentation. It's more about, it's less about execution, and it's more about experimentation, right? Because you need to resolve that uncertainty so that you can ideally evolve into something that's predictable, scalable, and worth growing. The founder of 500 Startups, another prominent, it's a prominent angel investor group. He says, a startup is a company that's confused about 1, what its product is, 2, who its customers are, and 3, how to make money. That sounds like a fairly bad predicament, but it's a great description of a lot of startups, because you might have an idea on what you should build and who you should sell to, but because of the uncertainty, you don't know for sure. So you need to validate that your hypotheses in terms of where you're trying to go are actually correct, right? And so this does a good job telling you the different wrinkles of uncertainty that Eric Ries is talking about. You're literally uncertain about almost everything. Got to figure things out. And that's early goals for a startup. It's to resolve uncertainty. It's not to make $100 million in revenue every year right away, right? And then the final thing that we see in the definition is coming from Mark Andreessen, who was one of the founders of Netscape, which was the first popularized consumer web browser. It really kind of marked the start of the dot-com bubble in the early 90s. He's also the founder of one of the most prominent Bay Area venture firms, which is Andreessen Horowitz. The shorthand for Andreessen Horowitz is A16Z. If you take Andreessen and Horowitz, you've got the A at the front, you got the Z at the end, and there's 16 letters in between, apparently. So he's really viewed also as a thought leader amongst investors in Silicon Valley. And he says, look, a startup seeks to build a real high growth, high margin, highly defensible business. And what we're talking about here is long-term margins and the ability to preserve them. Those things need to look attractive, because you know what startups do early on in their life? They do a lot of things, but from a financial perspective, they lose a lot of money. So if your cash flows are negative for many years, the only way you can generate value today is if they eventually become rather quite positive, right? And that can only happen if you're able to defend your turf. So you need defensibility, because if you don't have defensibility, you get the pleasure of losing a bunch of money while you're trying to figure things out. And once you've figured it out, all the entrants come in and erode all your profits. That seems like a fool's game. So you don't want to be the fool. So you want to identify businesses that you believe once they succeed and everyone knows about it, they can protect their turf. Without that, you shouldn't be optimistic as an investor, even if you think society will eventually benefit in this. Any questions so far? Or so far seems to make sense? Everything I'm saying makes sense, right? And I'm saying it. I'm not saying I'm reading it. I summarize these definitions here, right? So it's about ambition and upside, right? We've got uncertainty and we need scalability to be able to achieve the our large ambitions. In terms of uncertainty, we've got different types of uncertainty. What to produce, right? And it might be, we know we can produce it, but we don't know what the features should be. But it could also be like, we don't know if it's even possible to build this, right? So there's both those types of uncertainty inside of product uncertainty. There's what we call beachhead market uncertainty, which is usually the original market that you try to tackle for a startup is a subset of the total market that you hope to acquire in the long run, right? Facebook's initial market was what? Students at Harvard. After that, college students. After that, the entire world, right? How do you sequence that in a way that maximizes your likelihood of success? You need to be deliberate about this. So beachhead market uncertainty. You're not sure what you should be tackling. You need to try to figure that as well as you can, as quickly as you can. Then there's also go-to-market uncertainty. What is go-to-market uncertainty? So you know you have a great product that a target audience loves. You know that, but the audience doesn't necessarily know that. It's not one of these things in life where if you build it, everyone magically comes. You need to figure out how to get people to be aware of the value proposition you offer and to want to come to you, right? You see this a lot, by the way, with startups, because a lot of startups are founded by technical people who love making product, right? They want to design a new gadget, right? And a lot of these kind of engineering type people, they think sales is just a bunch of people in our programs who are just basically stealing a bunch of money from them, right? They don't realize like it's actually really difficult to sell. Going to market, even with a good product, is not an immediate thing, especially if you don't have a big marketing budget. So you need to figure out how to make your customer acquisition, right, scalable as well. It's not enough for you to have a product that you can build 1 billion of. You need to find 1 billion people to buy it. And that's a go-to-market uncertainty, which is different from finding the right product and the right way to build it. Then after you resolve that, another type of uncertainty is market expansion uncertainty, right? Because you might figure out the go-to-market for college students, but how do you go from that go-to-market to a broader go-to-market that gets everyone? In some cases, it's pretty easy to go from one to the other, but in other cases, you need to refigure things out completely, right? Maybe you're like a startup in the healthcare sector. You figured out how to grow in Canada, fabulous. Now you want to expand it to the US, which is a humongously bigger market, but guess what? Different regulations. Got to figure that out. Totally different, right? And so market expansion uncertainty is kind of like, how can you figure out go-to-markets for more and more markets beyond the beachhead, right? These are all different types of uncertainty. And early on, you don't know those things. You need to figure them out. So you need to figure out what should you prioritize in this list to figure out first, and how should you deliberately tackle all of these things, right? Another defining feature that actually wasn't in the list that I mentioned, but is that you start poor. Most startups don't start with like like a completely tappable pool of resources. They have to figure out a way to do things on the cheap because there's so much uncertainty. It's not everyone is willing to give them resources, right? And so you need to figure out how to resolve all this uncertainty in a cost-efficient and timely manner. That becomes an important part of startup strategy. Initial resource constraints are something that are hovering around the whole universe of early stage startup strategy, operations, what they're trying to do. You got to think about it, and it informs on a bunch of the things that we see that are a bit more unique for startups than for other things. And then the defensibility thing, which I think is pretty clear. So I don't feel the need to re-emphasize that again. Mark Andreessen put it nicely already.
Hey, Jara.
Yeah.
I had a quick question, actually.
Girl, by the way.
I was uncertain as to like what the differentiator is between beachhead market uncertainty and go-to-market uncertainty. It kind of seemed like the two kind of intertwined.
Um, like, well, I mean, just think about it, right? You build a product with a certain customer in mind, and you may be awesome at building products, so you build a great product for them. It's not like they magically learn that you've successfully done that, because there's a lot of people trying to sell me shit every day, right? And so those are two nuts to crack, not one, right? One is identify who you're selling to. The other one is successfully sell to in a way that's predictable and scalable. Now what I want to do quickly is tell you guys a little bit about why these characteristics are key, right? Because like, look, understanding like a startup starts with this high ambition. Okay, we can all accept that. But why is it that a high ambition startup has to have a lot of uncertainty, right? That may not be immediately obvious to you. My view on that is because, look, there's two types of high ambition projects. There's high ambition, low uncertainty projects, and there's high ambition, high uncertainty projects. The high ambition, low uncertainty projects, everyone's going to try to do them, including the large incumbents that have a hell of a lot of money, right? Look, most of the time, David does not beat Goliath if David is trying to do the same thing as Goliath. The way David wins is he does something that Goliath isn't willing to do. The only thing that Goliath is not willing to do, a large incumbent, is do a bunch of risky stuff, because they suffer more consequences from failure like that than you as a startup does, because you have less to lose than them, right? So basically the only stuff that startups can do that has actually high ambition, that they have a realistic chance of succeeding at, is the stuff that, at least for now, the large incumbents aren't willing to go all in on. And the main impediment to going all in on stuff for large incumbents is uncertainty. That's why you need a large uncertainty. So it's not something that like is a feature in and of itself, but it's kind of a consequence of understanding that like in the low uncertainty environment, you would have a ton of competition trying to do the same thing. And since you have so few resources, it would be tough. So you go for the ones where you at least have, it might be a low likelihood of making it work, but at least you have some hope, right? So that's why uncertainty is key. And there's a bunch of business books that have been written on entrepreneurship that talk about why large incumbents avoid high uncertainty innovation stuff. If you want one example of a very good book on that, there's a great book written by Clay Christensen. He was formerly a Harvard Business School professor. I think he passed away over the summer, actually. It's called The Innovator's Dilemma. It's really a well-done book that talks about that kind of reluctance to do extreme innovations on the part of incumbents. Scalability and defensibility are pretty obvious, right? Without defensibility, you'll never make the positive goodies you need to offset the losses early on. And scalability is necessary, because without scalability, you can't ever reach your potential anyway.
Can I ask a question here, please?
Yeah. Who's asking? Sorry.
Hola.
Oh, hey, how's it going? Hey, how's it going? I remember you.
You mentioned about like large incumbents not innovating. I've heard examples of like large companies that like are able to instill a culture of like small startup culture in which like small teams, highly innovative teams, are allowed to like build specific projects. Like Google allows people to like spend like 20% of their time on these side projects. I remember there's a pharma company that was mentioned in one of my entrepreneurship classes. Do you have like, would that be a counter to what you're saying?
So here's one thing I'm going to say. And partially this is a reaction to books like Clay Christensen's book, which is like large companies have started realizing that they have a systemic problem in terms of insufficient types of certain forms of innovation. And so they've been trying to kind of fix that. Actually, another way you can view some of the stuff we discuss in class is if you were going to work for a large company and you wanted to help spur innovation within that company, you could bring in some of the startup ethos into the company within a certain group, right? Yeah. So there is more and more of that over time. Absolutely, right? So maybe it's going to be even tougher and tougher for these standalone startups in the future. Who knows, right? It's too early to tell, right? But certainly there have been efforts. there have been efforts recently, but there have also been efforts and waves of trying to do that by corporations a long, long time ago, and they've screwed up in the past, right? So who knows, but you're right, there's efforts in that stuff, and certainly there's some companies that are good at innovating from within, for sure. My statements shouldn't be viewed as blanket statements, okay? Okay, so there's also this bullet point on startup age and being venture funded not being key. So a startup doesn't need to be a new company, because you have companies that start with moderate ambition, but eventually something clicks and they've stumbled onto something that's high potential, and then they shift gears and start acting like a startup. A great example in Montreal is Lightspeed Point of Sale. Something that people might not know, right? We think of Lightspeed Point of Sale as being the most successful startup in Montreal over the last, more than 10 years, right? 15 years. What most people don't know is when Lightspeed Point of Sale raised venture funding for the first time, they were a 7-year-old company. They didn't start as a startup. They started more as a, niche lifestyle business by Dax Da Silva. And he only started really accelerating growth once he realized, like, oh, he's onto something that's much broader than just, a semi-local Canadian market, right? So you can have companies that switch gears. Another great example is Nokia. I won't go into the details there. But they, for a period of time, they were a very successful, mobile phone company. Before iPhone kind of screwed them over. But they started as like a lumber company or something in Finland, right? So they kind of evolved into a technology market and then acted like a startup. And you don't need venture funding to be a startup either, right? In fact, what I would say is, as a startup, right, even if you're high ambition and you have all the characteristics that I'm mentioning, you should only raise venture funding if you need it. So either if you need those resources to fund your project, or if you really want to bring in VCs to help add value to your business. If you can achieve your growth and resolve these uncertainties without raising capital, that's better, because as you resolve more and more uncertainty, you'll get better and better pricing terms. So you would like to delay raising money as long as you possibly can, if you can, because you will build more wealth for yourself if things go well. I think what I'm going to have time to talk about in the lecture today, because we got 5 minutes, is I'm going to give you guys a quick overview of how this life cycle these unique characteristics of a startup inform the unique life cycle that we see for startups. So in particular, there's a lot of predictability among startups on how they try to sequentially resolve these 4 types of uncertainty. And that's what's going to inform on the various phases of the startup life cycle that I will talk in much more detail about starting next week. So I think of it as 3 phases before a startup would eventually exit. The first phase is what I call the search for product market fit. By the way, it's a term that I didn't invent. This is a practitioner-oriented term. That's the first phase. Second phase is the search for go-to-market fit, right? And then the final phase is aggressive scaling, or being a scale-up instead of a startup. And so I've kind of shown these 3 phases here. You'll also notice these numbers, 10, 20, 30, don't mean anything. Just the way my program works to generate these pictures, I have no choice. I have to include the numbers. But what you will notice is that these segments actually intersect a bit. I did that deliberately. It's because this is not like a video game where you're done level 1 and you go to level 2, then you're done level 2 and you go to level 3. Sometimes you start trying to tackle level 2 before you've fully resolved level 1. Same thing for 3 versus 2. Okay? So there is can be in some circumstances motivation for overlap on these things. But what is almost universally true with startups is that they are trying to start tackling search for product market fit. What is the search for product market fit? It's trying to jointly resolve 2 of the types of uncertainty that we have here. The product uncertainty, what to build, and can we build it? And beachhead markets uncertainty. Who should we try to sell this to first? You resolve that uncertainty first. And then you try to figure out, how can I successfully sell to that beachhead market? And once you successfully figure out the beachhead market, then you try to progressively expand to larger and larger and larger markets. And that's what's happening here. And honestly, that makes a lot of sense, right? It seems pretty crazy to me to try to aggressively sell to a beachhead market before I've even validated that people want what I'm selling, right? If you try to solve go-to-market fit before you solve product market fit, there is a very high likelihood that you are going to waste a lot of money because you haven't even validated that there's a hope and a dream there. Well, I guess there is a hope and a dream, but a realistic hope and a dream, right? So it makes sense, like, do some real thought into what product you should build and precisely for who. Because you might initially think, I should sell this to college students, but you do some, customer development surveys and stuff like that, and all of a sudden you find, wait a second, college students don't want them, but high school students love this, and their parents are willing to pay for it, right? Well, if you had tried to aggressively go to market with college students, you would be dead, right? Meanwhile, if you validate it, you've conserved resources by not wasting on the more aggressive marketing stuff, and you only start spending that money when you feel confident that there's some path to you being able to do that successfully, right? So it makes sense to do product market fit ideally before you start trying to figure out the repeatable and monetizable go-to-market strategy, right? And once you've figured out that repeatable and monetizable growth strategy, it's only at that point that you start really pushing the pedal to the metal and trying to like rinse, repeat, while also trying to find ways to expand, right? So that's why we have these three phases. And within the third phase is going to have multiple sub-phases where you're maybe going from expanding aggressively into the Canadian market, into the US market, right? And then you're initially selling to college students, then you also sell to young professionals, right? There's a bunch of ways to expand this market. And every time you want to do an expansion, you need to figure new things out and gradually expand more and more, right? But the most important thing that I want to highlight about these three phases is that phase 1 and phase 2 are predominantly experimental phases. We're testing and learning. Our goal is not necessarily to make profits yet or to be growing very fast. It's to learn, right? Meanwhile, in the third phase, it's about starting to try to grow rapidly. That's why we see a lot of growth curves for startups that look like hockey sticks, right? You guys have probably spent enough time in Canada to know what a hockey stick is, but right? That shift in the hockey stick is really about, well, we've solved phase 1 and phase 2, and now we're ready to push the pedal to the metal to try to grow rapidly. That's oftentimes what we see with startups. And so there's a really clear logic on why we sequence things this way. All right. So it's 5:25, so it's the end of the formal lecture time. So I'm going to stop things here for today. What I will do is I'm going to record a short add-on video to today's lecture where I quickly talk about some of these other like unique implications of startups that come from the definition beyond the life cycle of what they try to learn and execute. So I'll also talk about the unique funding life cycle. I'll talk about unique analytical challenges, and I'll talk about some other things, one unique classification and a unique distribution of returns. It may sound like a lot, but those other things are pretty quick to discuss. So probably each discussion of them is going to be like 2 minutes at most. All right. But I'll post it that way because I know, some of you guys might be in a time zone where it's kind of dreadfully late or early. I don't know how you define it. So I want to be respectful of your time. But I'll always kind of do that this way in this course. When I have a live session, if I don't finish all of what I intended to do, I'll add an add-on video, and I'll try to make that kind of brief and succinct so that you guys get to hear everything that's in my notes. And if you guys don't like that mode of doing things, let me know. It's one of those things that I can adapt over time. Sound good? All right, good stuff, everyone. One thing, I'm not sure if I announced it yet. Next week, right? So our sessions, if you look at the syllabus, there's a list of sessions, and in my last page of the syllabus, I talk about live versus not live sessions. Today was a live session, but we're going to be doing a mix of recorded and live sessions. Next week is recorded sessions because I actually need to be out of town for an important family matter. So I'm basically offline because of it. It's not under my control. So I'm going to put recordings for that. All the other instances where I do recordings, there's going to be a very strong practical justification for why I do it. I'm doing stuff on the board and stuff like that. And as you can see, I don't have a board in my office, so I need to record it in a classroom. And the only time that I have assigned by the university to record in a classroom is not during our class time. So I have no choice. McGill rules are saying that I must record them. All right. So hopefully folks are okay with this. Look at the syllabus to know when you're expected to be coming here live. Again, expected, not required, and not graded on it, just so we know. But again, my view is this course is more valuable if we get to have a bit of a discussion. And I'm actually happy you guys asked, good questions during the lecture today. More engagement here than I had, for instance, in my ACF class. Not saying anything bad about the ACF class or anything like that, but I'm happy that we had that. And I also see more of you, which I like. So yeah, we will see each other live in about, I guess, 9 days. I think it's 9 days. Not sure. No, I don't know. No, it's more like 12 days. Right. Roughly a week and a half. But next week, at some point during the week, I don't know when, it's really about when I have the time to do it. So I'll announce to you guys via email when I post, but I'll post recordings for the Tuesday and the Thursday lectures. I just don't commit to you guys that I'll post the Tuesday lecture on Monday night. Like, it could be posted as late as Friday. I don't think that's like a huge inconvenience because you guys can watch it on your own schedule to some extent. I mean, if this is a real touchy point for you guys, you can let me know on that as well. But since I only had access to Bronfman starting yesterday, I haven't been able to record everything yet. So, I'm kind of having to do those as I go along. So in any case, hope folks are cool with that. And I'm looking forward to seeing you guys again. And I hope today was at least maybe a little bit motivating. I don't know if it was motivating or boring, but we're going to cover way, way more over the course of the semester. So hopefully it's going to be valuable to you. Sound good? Okie dokie. Sorry that I went 5 minutes over. And I will see you guys, 10 days or so. I am on email over the next 10, 12 days or whatnot. So you guys can email me questions if you have, and it doesn't need to be specifically about what we talked about in class today. So if you look through some of the notes and you're like, oh, I'm curious about this, is this related to this example? I'll try to respond to you guys when I get these general interest questions, because I want to encourage your curiosity and your desire to learn outside of the narrow confines of this exact course. Okay, because I think that's very important, especially in the startup ecosystem sphere. All right? Okay, so I'll assume that's good, and I'll say bye-bye. Have a good one, everyone.
Have a great day.
Carol. But before I start going over details of different stages of the startup life cycle, I want to mention a few other kind of unique things and features of startups. And one is the unique funding life cycle. Sorry about that. That startups have, and in particular, the most striking feature of funding for startups is that startups raise their financing in multiple stages, right? So what you don't see startups do is raise all the capital they need to resolve phase 1, phase 2, and phase 3 at the start of their business. Instead, what they do is they raise the capital they need initially to be able to finance, potentially resolving product market fit. And then after they've resolved that, they tend to raise another round of funding to try to resolve go-to-market fit. And then they raise additional rounds of funding, again, generally more than one round. So they'll raise maybe, let's say the startup wants to expand from Canada to the US initially in their aggressive scaling for expansion. What they'll do is they'll raise a new round of funding after they've, again, successfully established a go-to-market for the Canadian market. When they raise that capital, they'll raise enough capital to be able to execute the strategy that they know works at scale for Canada. And then they'll also raise a bit more capital in order to be able to test expansion into the US market. If they succeed in expanding into the US market, then they'll raise another round of funding to execute in the US market and maybe to expand to the European market. So the aggressive scaling phase tends to have many rounds of funding embedded with it to coincide with the waves of expansion that startups generally tackle in their life cycle. And just to kind of highlight the fact that investment occurs in stages, this is just some data that comes from the North American Venture Capital Association. That's an organization that monitors and surveys venture capital firms. And what this data here provides is just a sense of the different rounds of funding that VC-funded startups raise. So this is data from 2016. And so what we can see is if we look at by number of deals, 51% of VC funding deals are early stage. This is pretty much Series A funding rounds, which tends to be a first round of funding for where venture capitalists participate. 26% of the deals are expansion, which is basically defined as Series B, Series C, so the second and third VC funding round. And then fourth VC funding round and beyond, about 19% of deals. There's also a small amount of seed deals. I should highlight that this data here is data on venture capital funding. So these seed stage investments are seed stage investments undertaken by venture capital firms. Most seed stage investments are actually done by angel investors or angel investor groups. So this is undercounting the number of seed deals that we have. So I wouldn't put much weight on this, but the relative percentages for early expansion and late stage do give you a rough sense of what the distribution of investment stages are in kind of beyond the seed stage for startups. I've shown both the data in terms of dollar invested and number of deals. So you'll notice, for instance, early stage, if we look in dollars invested, it's a lower percentage than with the number of deals case, right? 51% versus 34%. The reason why early stage represents a higher amount on a deal count basis than a dollar invested basis is because on average, early stage investment rounds involve smaller investments than later stage rounds. And so that's why the percentage is shifted a little bit more for late stage when we look at dollar invested as opposed to dollar count. But again, this highlights that startups generally raise multiple rounds of funding over their life cycle. Now, what's the logical justification for that? Well, one of the justifications for this is directly related to the high amount of uncertainty involved, especially early on with a startup. Given the high uncertainty, there's value when you're raising capital for your startup to provide investors with the option to choose whether to continue investing or not continue investing in your startup in the future, right? So let's think of two hypothetical scenarios, right? Scenario one, right? Let's say you think that it would cost $1 million for you to resolve product market fit, another $4 million to resolve search for go-to-market fit, and then let's say another $10 million to resolve aggressive scaling. So one option would be raise the entire $15 million in funding right at the beginning of the project. First of all, it might be impossible to do that because if your company isn't worth $15 million right now, you won't be able to raise more, $15 million. But even if your company was worth more than 15 million, raising this $15 million in funding would be extremely expensive because you would have to dramatically dilute your ownership position as a startup founder in the company. An alternative would be to say instead, well, why don't I just raise $1 million of funding right now? That will require me to sell off much less of the company than I would if I wanted to raise $15 million immediately. And then if I successfully navigate this first phase, then I raise my next round another $4 million to be able to, in anticipation, navigate the search for go-to-market fit stage. The benefit of delaying raising $4 million to the point in time that you enter phase 2 of the startup life cycle is once you enter phase 2 of the life cycle, you've resolved 2 forms of uncertainty. And so you've eliminated a substantial amount of failure risk for the startup, because it turns out most startups actually never successfully achieve product market fit. So once you've achieved it, you've dramatically lowered the amount of uncertainty and the failure risk associated with your startup. Well, that means that investors are going to value your company at a higher dollar amount, so that in order for you to raise $4 million once you enter this phase relative to the previous phase, you'll have to sell less of your company, right? And then, similarly, if you wait till you solve go-to-market fit before you raise the funding that you need to be able to finance aggressive scaling, then when you enter into the aggressive scaling stage, you'll again have to sell less of your company to get this $10 million to finance aggressive scaling, right? So that's one advantage associated with staged investment with startup investment, is that again, it limits the downside to investors, right? Because if the company never achieves product market fit, they lose $1 million, but they don't lose the full 15 million. And the flip side is, from the perspective of founders, if things go well, they don't need to sell as much of the company as they would if they tried to finance everything up front. So there's benefits to both sides in terms of staging financing because of the high level of uncertainty that startups have. Another benefit of stage investment is it provides high-powered incentives to founders, right? So, obviously, if you condition providing your a next round of funding, right? You provide 1 million of funding right now, but you only provide 4 million of funding if founders successfully achieve product market fit. That provides a stronger incentive to founders to do everything it takes to successfully resolve product market fit. Right, so there are these incentive advantages associated with staging our financing. Right, work hard or the funding will stop. Few other things that I'll mention in terms of stage investment. In terms of size of deals, there's, as I mentioned earlier, some notable differences between early stage and late stage. Late stage deals involve larger financial amounts than early stage ones. So if we compare, for instance, seed stage with a later stage aggressive expansion funding round, it's not uncommon to see the later stage funding round being up to 100 times or more larger than the earlier seed stage rounds. So as you get to later and later rounds, especially once you enter into, as I mentioned earlier, aggressive scaling, the size of funding rounds becomes larger. In terms of quantity of deals, it's the reverse. There are many more early stage funding deals than late stage deals. One of the reasons for that is there's a lot of early stage funding into startups where the startup doesn't successfully navigate and resolve the uncertainty that the given funding round is meant to help them solve, right? So if you raise a funding round to try to achieve product find product market fit, there's no guarantee that you're actually going to successfully do that. And if you don't do that, you don't raise later rounds of funding, right? So basically later stage deals tend to be a subset of the earlier stage ones. So you have fewer late stage deals than you have early stage deals. Another important thing to keep track of with funding rounds is that they tend to have very specific purposes, and there's systematic differences in the purpose of the different funding rounds. So as I mentioned earlier, right, an early funding round from a VC might have as its purpose helping a startup reach product market fit. The next funding round is to help them get a go-to-market fit, and then we tend to break down the aggressive scaling into other objectives related to expanding market and executing in a go-to-market strategy. So these things tend to be in sync, right? So the funding life cycle tends to be in sync with the startup life cycle. One thing that's useful to note with respect to media coverage on investments in startups is that media coverage tends to be biased towards early stage investment. And there's two reasons for that. One is related to the fact that later stage deals are substantially larger than early stage deals. But even though they're substantially larger, they don't generate the same proportion of additional media coverage. So if you have a late stage funding round that's 100 times larger than an early stage funding round, it's not going to receive 100 times more media coverage. So media coverage tends to track more the number of deals than the dollar invested in a deal. And so because of that, you might get a bit of a sense from media coverage that most investment in startups is early stage. And that's not an accurate statement. Another reason why there tends to be a bias towards early stage is if you look at the most famous VCs, right, and generally the media coverage keeps track of the investment activity of different venture capital funds. The most famous VCs do tend to be early stage, like venture capital funds that focus more on making early stage investments than late stage investments. And one of the reasons for that is if you make a successful early stage investment, you're going to generate a higher return than if you make a successful late stage investment. And the reason for that is pretty straightforward. When you invest early stage, there's a higher likelihood of success. So in order to a higher likelihood of failure. So in order to compensate you for the higher likelihood of failure, you need to have a higher upside return when things succeed. And so the VC funds that invest early stage that end up succeeding tend to generate higher returns than successful late stage funds. And media coverage tends to bias towards the more famous VCs. I'll also discuss a little bit the industries that startups generally enter. So this is, again, some data from the National Venture Capital Association. Again, looking at 2016, and what this looks at is across all venture capital investments, what was the distribution in terms of dollar invested into different industries. So we can see 40% of all dollar investment made by the venture capital sector, this is specifically in the US, in 2016, went to software startups. 13% went into the biotech sector, 8% went to consumer product and services, and then we've got our other categories here. And so this is kind of what the distribution looks like in 2016. This distribution varies over time. So one thing that people might be a little bit surprised is that you don't see hardware as an industry showing up prominently here. It's a pretty small component of the other segment right here. Now, this has not always been the case. So if you take a look at venture capital investment in the 1980s, for instance, in the 1980s, there would have been a much higher proportion. I think it was something between 15 and 20% of VC investment dollars went into hardware. So there is variation over time. One of the reasons why you see less investment in hardware now than you used to see is that hardware has just become a much more capital intensive business to enter into, right? So for instance, if we look at computer processors, so think of a company like Intel, right? When you want to develop a new computer processor, you need to make billions of dollars in investment, right? So if you look at an announcement by Intel on a new project they're undertaking or new production facility that they're building, right? These are multi-billion-dollar projects. And so something that's that capital intensive is difficult to fund as a startup, right? So you tend to see, more kind of, industries like software where generating an initial product can be done relatively cheaply. So if we look at some of the features of startup industries, so the first thing I'll point out is that this distribution of industries is much more concentrated than the distribution of industries in the overall economy, right? So if you look at the overall economy, there's substantially more industries than what we see represented here. And you'll have no single industry that has even more than a 10% weight in terms of the overall economy, right? So what this highlights is startups tend to disproportionately come from some industries like software than other industries. Why is that the case? Well, that kind of relates back to the definition of startups that we mentioned earlier, right? There were a few characteristics that we needed in order to be able to that we needed in startups. One was scalability. Not every industry is scalable. And so it's really only the more scalable industries where we see startups coming from. Another thing that you need with a startup is because startups start poor and have limited resources, you need to be entering into an industry that's relatively capital efficient, right? It needs to be possible to generate large scale, at least initially, right, with a relatively low amount of capital expenditures. Again, that's one of the reasons why we've seen a shift away from hardware in terms of startups relative to what we saw historically. In fact, if you take a look at hardware startups in modern times, they tend to be hardware startups that are focused more on application rather than building brand new forms of hardware. So you'll see more startups generating hardware where the components necessary for the hardware are, relatively speaking, off the shelf and available from third parties at low cost than developing fundamentally new hardware. Of course, there are counterexamples to that, but I'm just kind of describing the overall distribution of startups here. Another thing that we've historically seen is that most of the industries that startups come from tend to have limited regulatory barriers. So they tend to be regulation-light industries. Now, one major exception to the regulation-light characteristic is biotech. Same thing is also true, but to a lesser extent with medical devices. But we can see, right, biotech is a substantial component of startup investment activity. It's the second largest industry, and that's certainly a regulation-heavy industry. So that's a counterexample to the main features that we usually see with startup industries. An interesting thing to point out about biotech is that biotech actually has a substantially different life cycle than typical startups. So in particular, right, as I mentioned earlier, right, we have these different forms of uncertainty associated with most startups, right? I mentioned product uncertainty, beachhead market uncertainty, go-to-market uncertainty, and market expansion uncertainty. Well, if you look at biotech startups generally, by far, the disproportionate amount of uncertainty that they have is product uncertainty, right? So for most biotech startups, right, they are trying to develop maybe a new drug for a specific type of disease, right? So maybe you've got an oncology startup that wants to develop a new cancer drug, and the the real question is not, well, if they have an effective drug, how can they get the drug in the hands of patients that have that specific disease? The real question is, can they develop a drug that's actually effective at treating this disease, right? So one of the things that's unique with biotech is the main uncertainty associated with biotech startups is specifically product uncertainty as opposed to the other forms of uncertainty that I've highlighted, right? So, one of the things that, and another thing that's kind of common with biotech startups is that they're, generally once you've identified that a product works, right? So you have a drug that is effective for a specific type of treatment of a disease. Generally, that production of that drug is scalable. And generally, we understand the markets that this drug is going to be sold to pretty well, right? How many people have a certain form of cancer. How much you're able to sell this drug for because of how much coverage you can get through insurance and stuff like that, right? So with biotech, tend to tackle huge, well-understood markets so that there's some forms of uncertainty that aren't as present as they are with other startups, right? But you tend to have, as I mentioned earlier, much more product uncertainty, right? Can you actually build this drug, and is it going to be actually effective at treating a given disease? And then, of course, there's the biotech industry is also not something that I would call capital efficient either, because in order to be able to take a drug that's even effective and start selling it to customers, you actually need to go through an entire regulatory process that'll vary from country to country. In the US, it would be related to the FDA approval process. But one thing that's common across almost every country is that this is an extremely expensive and time-consuming process, right? So, in some sense, relative to most startups, we generally think of this industry as being low on this capital efficiency dimension as well. Now, because of those characteristics, the fact that most of the forms of uncertainty are not quite as present with biotech startups, but there's much more product uncertainty in biotech startups. What we've seen is that there's a pretty unique funding life cycle that's evolved with biotech startups. It's substantially different from what we see with other startups. One of the things is that a disproportionate amount of the investment in biotech is done by specialized life science VCs. And that makes sense, right? To the extent that you have a lot of product uncertainty, can you actually build this? Is this likely to work? You need to have scientific expertise in order to be able to assess that, right? In order to be able to assess, well, has the thing that this particular biotech startup is trying to do, has it been tried before or not? How novel is this? All of these things require a fairly specialized knowledge base to be able to do. So you see much more specialization in investment in biotech by VCs than you see in the other sectors. So if you look at software, fintech, IT, the VCs that invest in software are going to tend to also invest in these other sectors. Biotech and medical devices, to some extent as well, tend to be more specialized, where it's really VCs that focus on those sectors. So that's kind of one of the unique elements, much more specialization in investment in biotech. But another thing that's interesting with biotech startups is most of the startups that get funded are research focused. So they're in the product development stage. And what's interesting is with biotech startups, generally once they resolve enough product uncertainty, so once they show that they're able to build a drug that is, that has some evidence of effectiveness and doesn't do too much, doesn't have too many negative side effects, once they resolve enough of that scientific uncertainty, generally what you end up seeing is that those biotech companies will either get acquired by a larger biotech or pharmaceutical company, or they'll be able to exit via IPO. And the reason is that once you resolve enough product uncertainty, you have sufficiently little uncertainty left that it becomes easier to exit an investment. And it also kind of makes sense within this sector that you would have large established companies buying the research-focused companies once they show that their research has been successful. Because in some sense, if you think about what's left after resolving product uncertainty with a biotech startup, right, things like going to market, right, if you're a small research-focused startup, you would have to invest a lot of resources in order to be able to develop distribution channels and stuff like that. Large biotech companies have already done that, right? So in some sense, it's more efficient for a large biotech startup to take over a research project once the research project has been established to be sufficiently promising and a sufficient amount of uncertainty has been resolved, because the biotech company has the established distribution channels. They also have, experience navigating the regulatory approval process, so on and so forth. Right. So we tend to see this kind of pattern with biotech startups. Biotech startups, they're mainly funding research and trying to develop a promising drug. Once the evidence of the promise of the drug and the effectiveness of the drug is sufficiently established, generally those startups get acquired by larger established companies that have a comparative advantage in basically navigating the rest of the go-to-market and regulatory process. That's not what you see with most other types of startups. Most other types of startups continue to stay independent as they're starting to go to market. So another thing I should point out about regulation light, there has been an increase in the amount of startup activity in other regulated sectors as well. One example of this being fintech. But again, for the most part, the industries that have startup activity do tend to be capital efficient with low regulatory barriers, right? Biotech just being the most prominent exception to that pattern. Final thing that I'll highlight about kind of a unique aspect of startups is the unique distribution of outcomes that we have for investments in startups. And that's kind of one of the things that tends to be appealing to people when they're studying startups is, if you take a look at the most successful examples of startups, the returns that they generate to their early investors are spectacular. So it's not uncommon to see well over a 100 times return for successful early stage investments when these companies end up having, for instance, an IPO, an initial public offering type exit. So right, if you look at the distribution of returns to investors who invest in startups, right, you have a higher proportion of extremely high returns from this type of investment relative to any other type of investment, say in, for instance, public markets, so investments in stocks or bond markets and stuff like that. So the enormous returns happen much more often with startups. But the flip side is also you have much more failures as well. Just to kind of highlight this with real data, here I have a figure that looks at investments by VCs between 2004 and 2013. So this data here is off of over 20,000 VC investments. So if we look at investments during this period and we look at following this investment, what's the eventual payoff of this investment? And what I'm looking at here specifically is something called the investment multiple. So this is a very simple metric to evaluate the how successful an investment was. It's just the ratio of initial investment by the VC and exit payoff that goes to the VC. So if a VC invests $10 million and eventually when the company gets acquired or has an IPO, that payoff is worth $30 million, then the investment multiple for that VC in that investment round would be 30 divided by 10, which is 3, right? So obviously a higher investment multiple is better. And what I have here is the distribution of outcomes for VC investments. So about 65% of VC investments generate an investment multiple between 0 and 1. So they lose money. About 25% return between 1 and 5x the original investment. And then 5 to 10x represents about 6% of deals. And about 4% of deals generate greater than a 10x return. So actually, if you take a look at this distribution, it looks like something called a power law distribution, which is a right-skewed distribution that, again, has much higher likelihoods of negative outcomes, but also has a much higher likelihood of tail outcomes. One of the things I want to emphasize with this distribution is it also highlights something that's important to keep track of when you think about investing in startups as a venture capitalist, which is that VC investment is what I call an outliers game. What do I mean by that? What I mean by that is unless you invest in the startups that have a potential to generate the highest returns, right? You're not going to generate an attractive return to the investors in your venture capital fund. And we can kind of highlight that with back of the envelope calculations off of these numbers. So I'll just do a simple calculation. I'll look at what is the investment multiple of a VC investor, and I'm going to contrast two situations. Situation one, the VC invests proportionally in each of these 4 types of investments. Think of this as being, a failure. This is a negligible success, small success, medium success, and large success. First thing I'll do is I'll figure out, well, how effective is investment in the average VC sector? I'll need to make some assumptions here. So I'm going to assume that the average company in the failure category generates a 25%, a 0.25 investment multiple. A 0.5. Sorry, there's a typo here. This should be 0.5 instead of 0.25. So I'm just taking the midpoint here. So I'm assuming that in this 65%, on average, they're generating 0.5 investment multiple. So on average, it represents a loss of 50%. I'll take the midpoint in this range as well. So I'll assume that the small successes on average generate 3x return. I'll assume that the average of the medium successes is a 7.5 times return. And for the greater than 10, I'll assume an average investment multiple of 30. These are in line with data that I was able to get access to from other VC investment databases. And so given those assumptions, what would be the average investment multiple for the overall VC sector, right? Well, 65% of VC investments generate an investment multiple of 0.5, 25.3% generate on average 3, 5.9% on average 7.5, and 4% on average generate 30. That actually nets out to an investment multiple of 2.56. So that means on average in the VC sector, every dollar invested by VCs eventually returns $2.56. Now, before you get too excited about this return, VC investments are long-term investments. So this is, $1 becomes $2.56, but after many years. So the average VC investment, especially early stage, usually has a horizon of 5 to 10 years. So if we look at $1 becoming $2.56, that translates to an average annual return of about 14%. It's 14% after fees. Before fees, it's a little bit higher than that. It turns out 14% return on VC investments historically has been a relatively fair market return, right? And so what this highlights is that on average, VC investments generate an attractive return, like a fair return to investors. But that's only if a VC participates in all the different types of investments, right? So they participate in the failures, but also the small successes, medium successes, and importantly, the large successes. Now, one question we can ask is, well, what happens actually if a VC fund doesn't participate in the large successes in the home runs, right? So they miss out on 4% of these investments. What happens to the performance of that fund, right? Well, in that case, they would miss out on this 4%. So they'd be investing in 96% of the investments. And out of that 96%, 65% would be returning an investment multiple of 0.5, 25.3% an investment multiple of 3, and then 5.9% investment multiple of 7.5. Well, this translates to an investment multiple of 1.42. Right, so what that means is if a VC fund doesn't invest in the high successes, they experience a drop of 75% in net return, right? So 75% of this net return is driven by that small 4% of most successful investment outcomes. And if you want to get a sense of how, what an investment multiple of 1.42 represents, from the perspective of investors investing in a VC fund, if a VC fund was missing out on this 4% of home runs, the average return that the investors in the venture fund would earn, this is even before fees. So before fees, as I said, 2.56 translates to a more than 14% return. That return falls to between 3 and 7%. If you, it's actually after fees, it's even closer to like 2% as a return to investors from investing in the VC sector. And so what this highlights is if you've got a venture fund that doesn't participate in the home run investments, right, investment in VC is not an attractive investment vehicle for investors. And so what that highlights is if you're going to be making investments in venture capital firms, venture capital funds, I mean, you want to make sure that the VC has some potential of participating in the home run investments. And one thing that's important to highlight about home run investments is home run investments tend to be investments that we call contrarian and right. And so what that means is early on, when you're making the investment, the general consensus of the market is generally that the startup doesn't have a very high likelihood of success. And you're willing to take a bet in that contrarian investment and you end up being proven right. And so generally when you're trying to identify good targets for VC investment, right? So which startup, like when a VC is trying to think about what startups it should invest in, it generally tries to find a reason for why it's making a contrarian investment in the startup and why there's a likelihood that they could be right with that investment. If you've got a VC fund that only makes what we call these like checklist type investments in startups, so they only invest in a startup if it looks relatively attractive in almost every dimension, those startups are not going to tend to generate these home run type returns. And the reason for that is because the startup looks attractive on almost every dimension, right? Many people are going to be willing to invest in that startup. And since many VCs are going to be willing to invest in the startup, what is that going to do? That's going to lead to competition among different VCs to invest in that startup, and it's going to push up valuations. And if as an investor you buy in at a higher valuation, that's going to erode the upside return to your investment, right? And that's why these kind of consensus type startup investments don't tend to generate these high returns, because there's a lot of competition between different investors to invest in those startups, and that erodes the upside potential return. So VC funds that tend to only make those types of consensus investments into startups don't tend to generate attractive returns to their fund investors. All right, so this basically kind of highlights the kind of unique aspects of startups that I wanted to highlight and kind of connect to the to our original definition of a startup, which highlighted these different forms of uncertainty that startups exhibit. What we're going to do next is we're going to start actually discussing the different phases of the startup life cycle in a little bit more detail.